Was it the World Series? I don't remember
Well,
what it
we're
was.
live, Matt.
Oh, I guess we can't talk about it now.
We're
Just kidding.
live. No, I don't want to talk about the Yankees right now.
Oh, he's got his cup of Java. What are we
Yeah,
sipping
I,
on,
I
Steven?
need my coffee. I'm back on the coffee train.
Amen. All right, I'm excited to be here. What do we got? You got this whole thing planned, so
Yeah, so I wanted to talk to you about oil and gas.
oil. Talk
Yeah,
about oil. You cooking?
listen, oil and gas, oil and gas. So I actually put a few things together that I wanted to show you. Is I have some ideas, and I think that there is a indirect play with the picks and shovels, and we need more pipelines. We need more energy of all sources. And I think that there's a big opportunity in the energy infrastructure segment of the market. Do you agree with that?
Yeah, I'm interested to hear what you have to say. I think it's definitely something that's interesting. Especially, I think a lot of people are curious about it because of what's going on with AI and how much energy needs we need, and obviously we're exporting a lot more LNG to other nations than we have in the past. Obviously, since 2022 and sanctions on Russia and everything like that. So we'll see where I can dabble, where I can't. Maybe I can't talk about everything that I know, but we'll have a good conversation. And I know you prepared a lot of stuff. You're probably more knowledgeable about the midstream stuff than I am, so it'll be a
I
good time.
doubt that. I mean, you know more about the oil and gas sector than I do. So we'll see. I mean, just let me pull up a few things. All right, hold on. Still getting used to the back end. Everybody, please bear with me. I can't believe we have 87 people. This is awesome. Thank you. So I want to talk to Matt about oil and gas because he's one of the people that I bounce a lot of stuff off of when it comes to this. So,
Yeah, where are your bricks?
all right. It's so weird having to add this to screen. It's so weird. All right. So keep in mind, everybody, that once again, these are my opinions, and whatever Matt says, it's his opinions. So just please keep that in mind. Do your own due diligence. But we do a lot of research, and we're just going to have a conversation about this stuff. So I think you saw this slide last night with how much the EIA is expecting computing to expand with electricity. Not sure if you were on the stream when I showed this or not, but I was showing, I think Chris and admit this, how it's going to overtake pretty much everything by 2050, which is, I don't think anybody would have thought that a couple of years ago. I mean, this data center build out is absolutely crazy. And when I look at the electric power on the short term, it is absolutely skyrocketing.
Mm-hmm.
And that's attributed to how much CapEx is going out there. Now, on the short term EIA energy report, world consumption and production are both expanding. And, we were under a narrative for quite some time that transition to renewables, you had former President Biden say that in 10 years, oil would be significantly less of the global energy mix. And there was a big movement. I'm for renewable energy. It's just not, in my mind, realistic for there not to be an oil and gas footprint over the next couple of decades, just with how much it touches our lives. And I'm not big on the upstream sector, but I think that the midstream and energy infrastructure is very interesting because of the take or pay and fee based contracts. And it's the easiest way to transport crude, natural gas, hydrocarbons, et cetera, et cetera. And I really like the model because their revenues are protected.
Mm-hmm.
So when I look at where Exxon's at, they're showing by 2050, oil and gas is actually going to increase as their footprint of the global energy mix. Now, it may not be a percentage amount, but it's a volume amount. which is
And gas, right? It's not just oil; it's oil and gas.
oil and gas, which makes me bullish on transportation because there's no other way to transport except pipelines. That's the safest way to transport. And when I looked at four of my favorite midstreams, and I use these because they're MLPs, I don't put Enbridge, Kinder Morgan, or ONEOK in there because they're sea-based corps. So it's just a different structure. And these go by adjusted EBITDA and distributable cash flow, whereas the others, I look at free cash flow and straight EBITDA because MLPs, different metrics are more important. But energy transfer has always been interesting to me because it's a very low market cap to distributable cash flow, and it has a very low adjusted enterprise value to adjusted EBITDA. In the MLPs, a lot of people like the enterprise value more than market cap because it shows the debt. And then when I look at the actual market cap to adjusted EBITDA, you're under 4 for energy transfer, which is huge, big discount. And you're getting almost 8% on the distribution yield now with how much shares have fallen. So I was playing around with something, and I think this is, you probably know what I'm going to show. You may not, but I think this is really going to be telling. So we're going to play with this map before I really go through the stuff from energy transfer that I wanted to show you, get your opinion on. All right. So these are the major basins. And I like this from the EIA because it really tells a story. Because you could look at a pipeline map and not necessarily be able to picture what it's connected to. But this is all the major shale and tight oil plays. So this is where natural gas is produced from or upstream from, same as crude. So
it doesn't show the offshore stuff either. So it's tight oil and shale.
So crude oil pipelines, isn't it interesting that not a lot goes out to the west? It's all really central.
Mm-hmm.
I did not really realize that until I looked at this map. Because I always have it in my mind of what the different companies have. And it's very limited in the Powder River, Williston, that type of stuff.
That's what I was telling Chris. Well, I'll let you finish. I have my own theories. But
go ahead.
I've been thinking about this personally. I think that there's still a lot of oil to be made in the Four Corners area, and it's just not enough infrastructure. And I think there's just so much protected land there that unfortunately there's this inability to put infrastructure, and there's just a lot of trains. And so I still think that there's a lot of oil to be made in the United States. And I believe that as we peak out in the Permian, which is that blue on the west side of Texas, and kind of like the yellow, brown, green in the west side of Texas, that once that's kind of at its peak, we might get another 500,000 barrels a day or so out of that. But it's making about 6 million barrels a day at the moment. But once we kind of hit the 6.5, maybe 7 million barrels a day at its peak, I don't think we'll be able to get much more. And so we're already at about 13 million barrels a day. At what point do you kind of offset that production, right? And my thought process is really the only untapped area that is kind of untouched and is still growing is that kind of Uinta Basin sort of area west of the DJ Basin that you kind of have in Colorado. The Williston Basin, which is that big blue in the North Dakota area, is kind of on decline. So anyway, just some food for thought. But you can see that blue that's in Utah, that's very dependent upon railroads at the moment, and so not a lot of production can come out of that area for that reason.
And it's funny because when I bring up the investor deck, there's one company that really controls the pipelines in this area, and it's not one that you would necessarily think is the one. It's pretty interesting. So if we take that off, we go to petroleum. So this is your, when you talk about products, this is your refined stuff. This is your fuel for airplanes and all that other stuff. So once again, a lot in central. it's pretty interesting that it falls like this. Now, when I go natural gas,
Wow, that's insane.
much different. And the big difference is the interstate versus intrastate. And you can tell by the shading, the interstate is huge business, especially in Texas and Louisiana, because this is where you have most of your exporting. Now you have some on the East Coast, but your hubs are really around that Louisiana, Corpus Christi. What's the other one, big one down there besides Corpus Christi?
When you said Louisiana, I assume you mean Sabine Pass. And,
Sabine Pass, that's the one that I was
yeah.
thinking of. Yeah. So when I look at how all this is situated, I start thinking about, all right, who controls the most of this? And it comes back to one company, Energy Transfer. I mean, there's a couple that are huge, but for me, I just think Energy Transfer is undervalued right now. And when we go to their investor deck, that's not the entire map. Where's their entire map? I can't believe they don't have the full overlay in the investor deck. But one of the reasons I like
I didn't realize it came down so much.
Yeah, they're under 17.
That's awesome.
I'm going to look for one other. Let's see if it's in the Q2 presentation, the map I'm thinking of.
Because like a couple months ago when you and I were chatting, like, who am I going to buy in a pullback, right? And we were always talking like midstream won't pull back as much, but at the time I wasn't really looking at ET because it was still somewhat expensive, but it's kind of coming off of its high.
Yeah, I mean, when I look at their natural gas pipelines and where they are, it's just so strategic. And if I jump back to this one, when you look at their exporting capability, I mean, they have all the truncated hubs along the Louisiana coast, and their natural gas liquid capacity for NGLs is huge. It's one of the biggest. So I really think that this segment of the market's being disrespected at the moment because it's not interesting. It's not, I'm sure you have a theory about this, but our country does not run without energy. The global economy does not run without energy. Oil and gas touches everything. And it may not be as exciting as AI or SaaS software or technology, but you can't replicate their infrastructure. And that to me is one of those things. So if you got a company like Oklo that doesn't even generate revenue and is over a $10 billion market cap, there's a reason in 2020 Warren Buffett purchased 7,700 miles of natural gas pipelines from Dominion Energy. Okay. It's because it was easier. And if you talk about somebody who has the political clout, that has the capital, that has all the resources from actual monetary to political ties to get stuff built, it's Berkshire Hathaway. For them to buy 7,700 miles of natural gas pipelines instead of building them shows you the barriers to entry. And, you look at just the Permian, I mean, this is huge business for Energy Transfer, and this infrastructure is already set. So what do you need for pipelines? You need the permits, you need the land, you need the expertise, you need to actually build it, and you need to connect it to hubs, and you need the reputation. Energy Transfer has all of it. So there are not new companies coming in to entrench on their business. So I'm interested to hear what your theory is about this before I go further. And while you say that, I'm going to bring up two other investor decks.
Theories specifically on what?
Well, why the industry, you said you had a theory about why the northern part of North Dakota, Williston Basin, and Powder River Basin out in Utah are not more accessible to pipeline. And I think you're going to say something about why the industry is not getting a multiple.
I don't know if that's where I was specifically heading, but let me give the lay of the land. So at least I think that the midstream piece is going to be around for quite some time. I think a lot of people are still thinking that, oh, well, we're less reliant here in the United States on oil and gas, and we're getting more efficient. And so while we might not necessarily need as much demand over time, the thing with that is we are growing our export capacity vastly. And so at the moment, we produce about 84 BCF or so a day of gas, of which we export, let me see, it's like 105 times 48 divided by 365. Yeah, we export about 13 BCF of that at the moment. And so with that, I mean, you think about it, that is going to expand from about 13 BCF a day of export capacity to probably closer to 30 BCF of export capacity in the next 10 years. So we're exporting about 100 MTPA, and we're going to about 250 easily for what's been sanctioned, maybe even up to 300 by the end of 2040 timeframe. So that alone is just going to show you how much you need to keep this infrastructure around. So even if we don't necessarily need it in-house within our own remit to be able to be used, we are still going to be exporting it worldwide. And so it goes back to that Exxon slide that you had shown. Even if we reduce our reliance upon hydrocarbon fuels here in the United States, because we have the ability to potentially spend more on something like solar, even if it might be less efficient at the moment, or wind is less efficient, or what have you, and we can bypass the fact that we might need to increase the amount of usage in electricity because of computing power, and we just say we're just going with what we have today. We say, oh, we can replace it with solar, we can replace it with wind, etc. We're still going to be exporting more, right? Because at the moment, the UK with the regulatory environment is not allowing themselves to help backfill their opportunities there, and so their natural gas production is slowly decreasing. Australia is the same. You have many other basins around the world which were supplying natural gas to many other countries in the late 90s, early 2000s, and 2010s, which are no longer backfilling. And so it's very much reliant now on the US's of the world, the Qatars of the world, the even the Argentinas of the world that are actually starting to do FLNG plants in Western Africa, which is hopefully starting to come up to speed at a little bit on LNG, and maybe even Eastern Africa as well, as a Mozambique facility start to come online as well. But it's interesting, these countries that used to be very heavily supportive of their oil and gas industries are now somewhat turning their back because of the 2015 Paris Agreement, and trying to focus more on the renewable side. But going back to specifically midstream, you have to think, I agree with what Steve said earlier, and this is kind of what I was highlighting with respect to, I have theories upon this. You can't, oil's been around since the 1850s, 1860s, and we've really been using it now since very heavily since the 1890s. And so you can't just flip a switch overnight and say, okay, we're going all solar, we're going all wind, right? There has to be a transitionary period that you build up the infrastructure for other things. And so meanwhile, we're increasing demand. So it'd be one thing if we were to keep demand flat and we say, okay, well, we can at least backfill, as power plants get decommissioned, we can backfill that with solar, wind, etc., hydroelectric, whatever we can kind of work on. But now you have a growing infrastructure. Now you have a growing demand with all these computing power needing to come, and now you're exporting more to other countries, because obviously you can make more money by exporting it than keeping it in the United States. And so all of that is kind of demonstrating how the infrastructure is necessary within the United States to kind of keep up and right. And so it's an interesting sort of scenario that even if you think that energy usage within the US, we might not be using it, you're exporting more. and you need to grow it. So regardless of what you think, these pipelines are here for the next several decades. And another piece that I think Steve hit on very well is it's not like we were in the early 1900s anymore. When you think about building pipelines, you have so many jurisdictions and township permits, and you go across so many different communities that every single one of those communities has to be in alignment for you able to build these pipelines to go through. And so it's not like when these pipelines were originally built. Now that these pipelines are originally built, it's more about maintenance and kind of backfilling and not backfilling, making sure that the pipelines remain intact. And, it's more about maintenance rather than actually rebuilding anything and building new pipelines. But at the same time, you have to think, like, look what happened with the Keystone pipeline, right? That got shut down immediately. And it's still been in discussions for the last 5 to 10 years. So when you think about companies that have a moat and a footprint, Steve's right. I mean, these things have been around historically forever. They've had small mom and pops that have been regional, and they've continued to be consolidated under Energy Transfer, under ONEOK, under all these other companies. And it's here to stay. And with export, I think it's only going to get bigger and more necessary, because that just means more throughput, and more throughput means you have to either expand the pipelines themselves, or you just get more toll revenue, because obviously you're pushing more volume through the pipelines themselves.
Yeah,
so that's kind of where my theory is at.
I want to hit on something you said. I think there's going to be more consolidation. We've seen a lot of consolidation over the past 5 years, where a lot of the smaller players have been gobbled up by Energy Transfer, by ONEOK. I mean, look, Enbridge made a move last year where they acquired the 3 natural gas utility companies from Dominion. They're the only, and you would know this, and please correct me if I'm wrong in what I'm about to say. To my knowledge, Enbridge is the only energy infrastructure company that has a utility footprint inside of its business. I don't know of another one that has actual natural gas utilities. And Enbridge is now the largest in North America with natural gas utilities. So it's really interesting, because these are not assets that you can just go put up. And I want to share something that will put this in perspective. So when we look at, I keep forgetting to add the stage, how much the U.S. is producing of crude, we are almost 4 million barrels a day more than Russia and Saudi Arabia. And then Canada is number 4, and it's a significant drop off. I mean, we are still the dominant force in this. And then Russia, Saudi Arabia, and then Canada being number 4 is huge for us, because a lot of that passes down through the U.S. down to Texas, and the U.S. companies are getting the fees from that, which is huge. And if we look at crude production over the past decade, I mean, you were at under 9 million barrels per day in 2016. I mean, it has gone up drastically. And from what the EIA is showing us, it looks like this production level is going to continue to go up. Exxon certainly thinks so. So when I start looking at, besides the actual numbers on where I see value, but the footprints, Kinder Morgan, I mean, they straight up say it, irreplaceable infrastructure portfolio. And they say that for a reason. When you look at their footprint, this is a company that's moving 40% of U.S. natural gas production throughout the country. They have a big exporting business. They're predominantly a natural gas company. I mean, huge infrastructure. Enbridge is one of my favorite. This slide does not do it enough justice. The yellow is the natural gas utility companies. one of the best companies, in my opinion, for a full, well-rounded infrastructure play. I believe they've increased the dividend for more than 3 decades now, maybe 28 years. I'll have to check. But huge liquid pipeline business, huge natural gas business, and they have a very big exporting business. And I do think exporting LNG is the future. And a lot of emphasis is being put on new companies. But there are true energy infrastructure plays that are completely vertically integrated with this. And then keep in mind, when we looked at the energy map where all the pipelines were in the middle America, look at how much of that ONEOK controls. Like they're the play. When you think about Williston, the Bakken, and Powder River, they're the play.
But they don't go into Utah.
Right. Now, why is it that they don't go into Utah? And we're not talking about Johnny Utah.
Land.
We're not talking about Johnny Utah. You know what movie Johnny Utah is from, Matt?
No, I'm too young.
No, don't do that to me. Don't pull him it. Don't do that.
Too much of a baby.
You know you're trolling me now.
No, I'm drawing a blank.
Don't tell me you've never seen Point Break.
Point Break?
Point Break. Keanu Reeves, Patrick Swayze, Gary Busey. Utah, give me 2.
Yeah, I feel like I have. I
Utah, give me 2. Anthony Kiedis from Red Chili Peppers.
I feel like I have. I feel like I definitely have. I was really young. It was not recently.
Man, I don't even know what to do.
I've seen it. I remember seeing it. It was just it was very, very young.
So I think ONEOK is very interesting because of the footprint. And I think you're right. I think so many people are focusing on the Permian, and they have a huge footprint in the Permian, but they're one of the only players for the Bakken and the Williston. And I think that that's going to be an asset base that continues to be developed. And I do think the Powder River is underutilized right now.
So who has the main infrastructure? So let me give people the lay of the land, right? So Canada produces about 4.5 million barrels a day, of which they export about 2.5 million barrels a day to the United States. It's not because we need it or anything like that. We pull it in from Canada because we have the refining capacity to be able to refine heavier oil crudes. So in that Midwest region, the refineries there have been kind of outfitted to refine the heavier crudes that Western Canada kind of produces. So they do not have that sort of capacity to refine that in Canada themselves. So in order for that to work, it's almost like we take 2.5 million barrels a day from Canada, we refine it, we then distribute it across the United States infrastructure. In the meantime, we then refine it, and then we move things up to the eastern side towards Toronto, right? And so if you actually look at a map of Canada in terms of their pipelines, they don't actually have any pipelines that go from Western Canada to Toronto, I don't think. So it's actually pretty interesting how that piece works. If you were to actually pull up a lot of these pipelines again, it's like, if anything, you kind of see Toronto connected to the New York area, and then you'll see Canada connected up to the North Dakotas, back down to the Midwestern regions to be able to export and refine those. But it's a symbiotic relationship that I don't think people fully comprehend. And so once again, just want to reiterate, like, Canada's not going away. They have some of the largest oil reserves in the world that have been yet to be developed, because it's very labor intensive, very carbon intensive as well. That might get me into trouble. Some people say it's not as carbon intensive as once was, but overall, it still has a long lifeline ahead of it. And so with that, I think it's gonna be a huge opportunity still to keep that infrastructure in kind of the Williston area, kind of North Dakota area up and running, because you need to bring that fuel down, or that heavy oil down from Western Canada.
And one of the companies that's huge in transporting that energy is Enbridge. It's just, I get excited about this because when you see how their revenue is projected, so we should probably cover that. A lot of these transportation companies have take or pay or fee-based contracts. So
Right.
take or pay, if Matt is the energy infrastructure company and I'm the upstream producer, I produce X amount of barrels. I'm going to forecast I'm going to produce 1,000 barrels this year. I'm going to say to Matt, I'm going to produce 1,000. I need to pay for the space for a volume for 1,000 barrels. I'm going to pay him. Now, whether that's on that 30 terms, a monthly fee for the year, whatever it is, whatever the negotiation is, take or pay means that I'm paying him regardless of how much. I can use the full 1,000 volume or 500. It doesn't matter how much I utilize. His company is getting paid for the full utilization I contract for. Fee-based is pretty much, it's similar because you're setting the fee for the volume, and it doesn't change with commodity pricing. So doesn't matter if oil goes down from 70 to 60, you're still contracted at the same rate. So I love these because they're toll booths, and you can't rebuild this infrastructure. Like, think about how long it would take to get the permitting process, to get the land, build it, and actually connect it to the hubs where you need to go. You're talking about what, 5 to 10 years, Matt? I mean, I'm just making up a number, but it's certainly not as easy as spinning up a new SaaS company. Like, you can't just go and hire a bunch of software engineers from Stanford or MIT or somewhere, come up with an idea, rebuild it, then finally take it to market. I mean, theoretically, anybody can build a software company. You
Yeah,
can't
you're
build
talking
an infrastructure.
about layers of government and regulation, right? You're talking about from the district level to the township level to the state level to the federal level. I mean, it's layers upon layers, and not only that, but individual landowners sometimes. And so, um, having to have town halls. Do you guys agree with it? What are you guys concerned about? People are thinking that you're going to be transmitting toxic sludge through your community. Stuff like that. It's very interesting.
Matt, give me 1 sec.
Oh, Steve's in trouble. They hung up on him. This is a play-by-play of Steve on the phone. Is it the milk dealer? Did he get the whole package? Oh, he's covering his mouth. He's covered his mouth. It's a very important milk deal. They gave him 2% instead of whole. Not good. You can see the frustration in Steve's eyes.
Frustration in my eyes. Very funny, Matt. So, and these companies, they generate so much capital. I mean, Energy Transfer, these are not small companies. 14.72 billion in annualized EBITDA right now. It is really interesting. And look, this is a company that was trading for $21.45 earlier in the year, this winter, and it's down to 16.80. The dividend is almost, or the distribution is almost 8%. Like, I think that there's an opportunity here because you can't recreate their infrastructure. And I am not as concerned with their debt load at the moment because as rates come down, they're going to be able to refinance debt, and they'll be able to expand their margins because their interest expenses will be less. And right now, their interest expenses are 3.3 billion a year.
So that was going to be my interest, or my question is, the EBITDA is before interest and taxes, right?
Correct.
So
Yes.
when you look at it, it's like, my question then would be on Energy Transfer. It's like, well, how much are they paying? So when you say that 3 billion, is that specific ET, or is that, whom is that?
No, ET as the parent company. So
It's 3.5 billion.
Yeah. Consolidated, 3.3 billion.
So then that's where the problem is, and that's why it's trading at such a discount to EBITDA, is because when you get to a net income perspective, and I don't like to look at things from a net income perspective, but you do have to take into account, because like you stated, like if you're paying $3.5 billion in annual interest, that's important. But I guess my question then goes as to what is the interest rates on general that they're paying? Is it really that high? And if it's not, then that's where you could see this really not be that big of a deal. But if it is high, I don't know how much, because they have done some consolidation recently, but I'm not sure if that's been in 2022, 2023, 2024. And if it was, then obviously then you're right? It could lead to much lower interest rates. And that would then increase the net income, which would then skyrocket the ability for cash distributions, etc. So I'm curious what your thoughts are with that, because that's where you're heading, I assume.
Yeah, I mean, the last time I looked at it, it looked like if rates come down to about 3%, they'll be able to refi some debt. I have not run the calculations on how much they could save, but I do think they can shave a couple $100 million off in the next couple of years. So I am planning on doing a full analysis on their debt load, but it will also make future acquisitions cheaper, because if they need to tap the debt market, they'll be able to borrow at a better price.
Interesting.
So, I mean,
so let me ask a question, because you're a dividend guy through and through, right? And so, yeah, probably the last I checked, you had over 300 people watching. Now you're at over 350 people watching. So for the 350 people watching, I just want to get people to know, like, I don't want people to run out and be like, oh my God, Steve's bullish on ET. And then 5 months down the road, be like, oh my God, ET is not at $100 a share. Why did I invest in this, right? When you're investing in ET, are you investing in it because you think in the long term it's going to go over the next several years to maybe $20, $25, and it's going to be a low and slow sort of process, and you're really investing in it to be able to supplement that slow capital appreciation with a dividend? Or are you thinking that there's going to be, with this rate cutting cycle, a large upswing? And I want people to kind of recognize this and hear this from the horse's mouth, because you are a different type of investor than, say, the like the emits of the world, who generally speaking, like a lot of the technology is fintech, and you do too as well, right? But you'd also look at some of these more, like me, traditional businesses like pipelines and infrastructure and energy plays, which some people don't. Some people strictly focus on technology. And so I just want people to understand, with where their investment strategies are at, if even this is something that they should even be thinking about. Because for me, it's something that it's always enticing to me, because I'm getting back into that place where I was able to grow my portfolio very well over the past several years. I want to start dabbling back into the dividends. This is something that is enticing me. And I've started to recently dabble back into energy stocks, other than my share-based compensation. Full disclosure there. But I don't necessarily know if everybody on stream in the chat is wanting to focus on that. So I just wanted to get your thoughts.
Yeah. So look, nobody should invest in anything I invest in because I invest in it. Let's start off with that. I don't know anybody else's situation. I do a tremendous amount of research, and my strategy is proprietary to me. Same way your strategy is proprietary to you. I do not envision Energy Transfer going to 50, 60, 70 bucks. Okay. Regardless of where I think it should be valued. But I believe that there's an opportunity for me because, once again, keep in mind, they are an MLP. So they have a different tax structure. If you hold it in a taxable account, you will get a K1. So everybody should talk to their accountant about what type of account is best. I mean, there's pros and cons for both. I have different baskets of my portfolio, and I have an income side that I allocate capital to. And on that side, I happen to like the distribution being around 8%. It allows me to buy back 8 shares on every 100 every year as I reinvest it, and that doesn't include compounding. So really, you're getting around 9 shares a year with the compounding.
Yeah.
So you hold it for 5-10 years, that really works magic. So I believe that Energy Transfer is undervalued. I believe that there is a big opportunity for them to close the gap of how some of their peers are trading. There's an opportunity for me to collect a big distribution and throw that capital back into Energy Transfer. And I'm willing to hold it for 10, 20 years. You know, I've been a shareholder when they were Energy Transfer partners, and that was probably 2018, 2017 area. So when you look at the data center build out, I just think that we're going to see a broad market rally of companies that are integrated into that. And you can't have data center build out without energy transportation. And Energy Transfer is one of the big players in that game. I think there's going to be several winners. I like Enterprise Pride Partners. I like Kinder Morgan. I like Enbridge. I like 10KE. And I think that there's a lot of good companies. And one of the other ways to play it is the AMLP from Illyrian. What investment house is that?
I think it's Illyrian. Yeah.
So, I mean,
ALERIN or
Yeah.
RIAN. Yeah.
Yeah, they're just a simple ETF that gives you exposure to all of them. I mean,
Yeah.
to me, it's just really, it's an interesting sector to be in. And I think it's something that's overlooked. And it's not exciting. It's not going to get you triple digit returns anytime soon or maybe ever. But I do think there's an opportunity for capital appreciation and income generation. And I don't think that every investor is the same. I think there are investors that are more interested in a combination of income and with the prospects of capital appreciation.
Mm-hmm.
That's
I think it's one of those things that, regardless of how it depreciated extensively in share price in 2020, I still think it's one of those low risk businesses, just because our infrastructure is built upon it. And so it's something to me where, yes, you might not be able to get a 20-25% annualized yield or anything like that. Sorry, return, not yield. You won't be able to get a 20-25% annualized return, but it's much lower risk than some of these other opportunities that will be potentially yielding 20-25%, right? And so I don't know. It depends on who and what sort of play somebody is looking for in their portfolio.
So I actually just built something out because even though we're talking about energy infrastructure, the numbers are pretty incredible when I look at the two major upstreams, Chevron and ExxonMobil. So I'm going to share my screen again, and this is going to surprise you. I really think this is going to surprise you. I think it's going to surprise everybody in the chat also. And I'm also interested if everybody in the chat finds this information useful, because I am planning on doing a video on how I come up with all this stuff and do everything. But look, I love free cash flow. Okay. I think it's a better metric for me to judge a company because net income, there are more ways to, I don't want to use the word manipulate, but impact it when you talk about taxes and everything else. Free cash flow is cash in, cash out. Now, Chevron and Exxon are trading at free cash flow multiples of under 20. To me, that's insane. I mean, to me, if you're trading at under 20 times free cash flow and you're a big company like this, to me, that's a value play if you're not on a decline. And these companies, from what we've seen from the EIA and from all the reports that I look at, if oil and gas production is going to increase and utilization rates is going to increase, look, investing in upstream production is very difficult. But the two big super majors to me are trading at very interesting multiples on free cash flow. I mean, Chevron, this doesn't even include their acquisition of Hess, which we're going to see over the next year how that plays out. And I think that's going to be transformational for them. And then when I look at them on a forward EPS, Chevron is trading at 13 and a half times 2027 earnings with almost 50% EPS growth on the horizon. How crazy is that? Now, granted, Exxon is a little bit cheaper and has a lot of EPS growth. I mean, I got to say it. I think Exxon and Chevron look quite interesting at these levels compared to how the rest of the market is going. I mean, what do you think, Matt?
I think it's interesting. What I would say is, once again, it's trying to understand where this sort of position fits in someone's portfolio. I do anticipate that there's a lot of remaining running room, specifically in Guyana. I think that they just sanctioned their 7th FPSO, and so now Chevron and Exxon are partners in Guyana, and so with that, that'll help with respect to their growth and free cash flow. And so they could focus very low break evens there for them. And I think there's a lot of remaining opportunities. They have yet to hit a kind of turning point in their, what's the word I'm looking for? Creaming curve for discoveries. So yes, I mean, they were hitting like a 95% success rate for, their wildcat exploration wells. I think it has now kind of come down to like 80%, but it's not like they're in 1 in 3 territory where like most exploration wildcatting is. So they're still hitting, like, pretty much shooting fish in a barrel at this point. And so with that, I think that they're still doing extremely well, and they have a lot of running room still left in Guyana. And from what I remember, and I'm going to get the quote wrong, but when I typed this in chat last night, you guys had 1 billion people in here, so it was probably difficult to see it. But this was back in 2022 or 2023 when they really started to analyze a lot of these FPSOs that were going out into Guyana. And it was Hess, I believe, that was basically stating that for every FPSO that they sanctioned, they were anticipating a rule of thumb, right? So some boats are going to be more profitable than others. Some are going to be slightly bigger than others. Some projects are going to do better than others. But they were kind of anticipating approximately $1 billion in free cash flow per boat annualized, right? And so you think about it, they're about to put out their, they have 4 boats up there now. That's $4 billion in free cash flow specifically to them, right? To Hess, that project specifically for Hess. They have 7 sanctioned, so they have another 3 that are on the way, and they have probably another 3 that are going to be sanctioned within the next 4 to 5 years, and who knows at what point they're going to be finished. So you think about how much free cash flow that's going to add now that Hess has been acquired by Chevron, how much bottom line that is going to add to Chevron, coupled with their phenomenal Permian position, which I believe is over 1 million barrels a day now. It's interesting to see where they're going to go from there. It very much is dependent upon, though, I think what people want in their portfolio. It's very difficult when you start getting to this 3 to 4 million barrels a day range to maintain 3 to 4 million barrels a day. It's very capital intensive, as Steve kind of alluded to, right? You have general production declines of about 20% annualized. And so if you were not to invest at all and you were to say have 4 million barrels a day, by the next year, you would be at 3.2 million barrels a day. But you have to have an extensive capital program of, say, $25 to $30 billion annualized to be able to maintain production, not even grow production. So to be able to grow production, you either need to distribute shares and be able to add more capex to that bottom line to be able to grow. And so you think, yes, they're making a lot of money when it comes to what Steve was kind of showing with respect to the free cash flow. They're generating a lot of cash, but if oil prices dip, which Steve showed a very good graphic at the beginning. At the moment, we're running at a deficit. We're actually building supply around the world comparatively to where we were in 2022, 2023, when things were starting to get back up and running after the pandemic. And not only that, but OPEC is actually planning, I think, even later today, to raise their output. And so with that, you're going to continue to see pressure on oil prices, right? We're already at $60 a barrel. Granted, Guyana and Permian, I think a lot of those assets can make profit down into the $35, $40 range. But when you think about it, all that's going to eat away at your free cash flow. And so it's a long-term game in oil and gas, right? You might want to add monthly into stuff like this. This is one of those things where, this is where it benefits somebody like myself who likes to add monthly and doesn't just like throw large chunks of capital into the market. What I'll do is I'll initiate specifically for these cyclical type positions in upstream. It's very different from midstream, but midstream can be somewhat cyclical, but not nearly to the extent of, say, upstream. If you're looking at upstream, we're getting to a place where we were nowhere where we were in terms of profitability in 2022 to where we are here in 2025, which is why I sold a lot of my upstream positions back in, I think, July of 2023, because I saw we would be at this point. And so I had a lot of Exxon, had a lot of Shell, had a lot of undisclosed oil company shares. And so I sold a lot of that, just recognizing that, it was going to be kind of wavering in this kind of lower oil price environment, going from $90 a barrel to $60 a barrel. And, yes, some of these stocks like Exxon, I sold a little bit too early, but I invested in things like that made me a lot of money, Palantir, Rocket Lab, other things like that. And that has turned out really well. But now I've started to lean back into the upstream, and recognizing that we're at $60 a barrel. And I think there's going to be something, whether it's some sort of pullback or some sort of recession. You're starting to see a lot of layoffs. And with that, people are going to be staying at home. People are not going to drive as less. But at the end of the day, you have these world economies that run on oil and gas production. You have to think the Middle East is, generally speaking, running off of the oil exports. That's how their governments generate a lot of money. And so a lot of the times they don't want to cut production, right? It's not like the US companies that can choke back production a little bit and, try to help with kind of supporting price. It's like these countries rely on supporting their economies by oil exports. And so it's difficult for them to sit around a table and say, yep, we're going to cut production by X to be able to support the price, when, that means directly that they're cutting the amount of money that they're going to be able to give to their citizens. So it's an interesting sort of dynamic out there. And I think what I'm trying to say is you have to be cautious and keep your head on a swivel if you're going to invest in companies like this. I don't think it's a bad entry point to start adding slowly and dollar cost averaging into companies like Exxon and Chevron. But at the same time, I don't think they're dirt cheap either. And I think that where you need to potentially think about is wait for a time where oil dips into the 40s or even low 50s, when there is a massive, say, scare of recession or something like that. And that's when you're going to see the great opportunities. And
you're right. And I think it's important to hit on the idea that these companies in the upstream and even energy infrastructure do not get multiples. Like they traditionally do not trade at high multiples. So even though Chevron may look cheap against tech companies, that normally trades there. Now, this is something that to me is really incredible. Chevron is generating a 4.5% yield on its dividend with 37 years of growth. And they're increasing the dividend on average by almost 6% a year. So when I look at the dividend history, I mean, That's gangbusters on dividend growth.
They do a good
Absolute
job.
gangbusters. Like I do think if I was going to be investing in, and I don't own Chevron yet, it's something I plan on owning. I owned it back in the day and I exited years ago. It is something that is at the very top of my watch list because I think the Hess deal is transformational. And I do think they're going to continue to reward shareholders through dividends and buybacks. And you're getting such a big yield on it that 4.5% dividend, especially when the Fed is cutting rates, I think is going to look much more enticing to a lot of investors. And when you look at the amount of capital sitting in money market accounts, you have $7.5 trillion on the sideline. Those investors are not looking to take on a lot of risk. I think they're going to be gravitating toward companies like Chevron, companies that they've heard of, that they know, that generate a good yield, that is also growing the dividend when the Fed is cutting rates. So they, in their minds, they'll come out ahead of the game. So Chevron looks very interesting to me.
Yeah, I just want to caution people though, like if you're investing in a Chevron and Exxon, I'd still say it's relatively good times for these companies right now. Upstream's not in a horrible position, and so if you're investing in something like this, don't be surprised that in a downturn, the oil price causes the stock price to drop.
Correct.
For Exxon down to the $60 to $70 per share range, and for Chevron, what's about 70% of 153 times 0.7? Yeah, I wouldn't be surprised if Chevron drops to the 90s, 100s, and so yeah, we'll just caution people. Just use that, and to me, that's not a time where you panic. That's a time where you lean into it. Because these are world-class organizations that are really, I shouldn't. Let me phrase this so I don't get myself in trouble if anybody from my office is listening. These are my opinions, not my company's opinions. Exxon and Chevron have done a phenomenal job setting themselves up for the next several decades of production growth and sustaining into world-class basins that will be around when you think about where we are. I don't want to say we're in an end game, but we're definitely, with how well renewables are growing and wind is growing comparatively to where we were, let's say 12, 15 years ago, when people thought that 2008 was peak oil and stuff like that. We're in a much further place than we were 13 to 15 years on. And so with this, you're seeing renewables grow at a rapid pace. So now it is definitely much more justifiable to find the large oil reservoirs that will be around to the 2050s and beyond. And so that means things like the Permian. That means things like Guyana. That means things like the Gulf of Mexico or America, other reservoirs that will be around. So it doesn't make sense to be, shifting your entire portfolio to something that might be great to like sell out of something that will just be here between now and 2035, right? Don't situate your company, especially if you're, say, Exxon, a $450 billion market cap company. It doesn't make sense to pivot to something that's going to generate you a large cap of money for the next 10 years just to try to get yourself back into the things that are going to be here for 2050, 60, 70, and beyond. And so you're really thinking about how do you get into this cookie cutter, long-term, squeeze your margins out over time sort of mentality, right? How can you get the most infrastructure in place? How can you own the most out of these large oil fields? Because these are the things that are going to be around for a long time, and you don't want to be fighting for them in 10 years time, because 10 years time, it's going to be much more difficult to be able to buy these things. So I think you're seeing a lot of folks invest heavily into some of these plays now, because once it comes time, when oil is potentially going to be on the decline, and maybe it's gas that's going to be more useful, they're going to use that capital to really start funding into the renewable side. And I don't think Chevron and Exxon have moved that direction yet, but there will be a point in which they think, okay, now is the time. Yeah.
And that'll probably come over the next decade or so where they'll start. But right now, they're really chugging away and consolidating. And look, they're the two big companies in the room. I happen to like both of them. I'm an Exxon shareholder. I would like to be a Chevron shareholder. I need to find an optimal time to get in. I don't know when. And look, just because it is right for me doesn't mean it's right for anybody else. I do want to address one thing that was asked in the chat. Somebody had asked, and I don't remember who it was, and I can't go back and find it, but they asked me to explain the money market statement that I made. So when you go to the St. Louis Fed and you look at the amount of capital currently in money market accounts, you got $7.48 trillion. Okay. When the Fed was taking rates up in 2022, we were about 5 trillion. So rates went up to the highest level they've been since the early 80s, if I'm not mistaken. And we added 2.5 trillion in money markets. So these are people that are looking to harvest income from the sidelines without taking risk. We have not seen an exodus out of money markets. And keep in mind, this does not include bonds. This does not include CDs. This is just money markets. There's a lot of capital on the sidelines. Now, when I go to the FedWatch tool, why didn't it update? Hold on. Let's reshare. And I look at where the Fed sees rates over the next couple of years. And you can go to CME Group and you can go to the FedWatch tool. I mean, right now, they're expecting that we get a cut at the next meeting, the December meeting. They're expecting the most likely scenario is that we get 2 cuts for the rest of the year. Then when you go to the dot plot, they're expecting that we're going to be around 3.25 by the end of 2026. So if you're around 3.25, you're going to be generating, depending on short-term assets, probably right around there, maybe just a little less. But I think there's going to be a lot of capital for trying to front run that once it's not advantageous anymore to stay on the sideline. And if you're generating, what are money markets doing right now? 4% or so?
3.8 is Schwab.
All right. So
we keep our Airbnb excess capital. So I watch it pretty religiously.
3.8 to 4. You're getting a bigger yield on Chevron right now. Chevron's grown the dividend for 37 years, and it's a company that resonates with a lot of people. I think that it's not just Chevron. There's other companies, but because of where the yield is on Chevron and their growth on the dividend, I think you'll see capital when it comes off the sidelines move into companies like Chevron that have that solid yield, that have decades of a track record increasing the dividend and with a good growth rate, because as the interest you can generate on the sideline declines, you're locking in a yield on cost. So in a couple of years from now, even though the Chevron's dividend yield, if the share price stays flat, let's just say it's still 4.5%, your yield on cost may be 7% because all the other income you've generated and reinvested back into it, and you're generating more income because you have more shares. So that's how a lot of income investors look at things. And when I look at it like that, I do see an opportunity in some of these companies. And the energy sector is notorious for large dividends and large yields. And I'm not looking to try to pick which are going to be the winners that get acquired. I'm not smart enough to do that. I don't have any information that lets me do that. But I think picking the winners that have a big track record for me is good for my dividend portfolio.
Yeah, the dividend thing is nice. And I think people need to think about where they are. And this is why I always try to tell people is like, people need to think about where they're at, right? For me, I could take the risk of, being in some of these riskier assets long term because it's just me, right? And I don't have a lot of capital, but think about your families, think about, what other things you have, because I see a lot of people being extremely risky in what they're investing in. And my fear is I would hate to see somebody that doesn't have the emotional temperance that when something's down 50-60% to just sell it. They're like, oh my God, it's going to go to zero, I'm going to sell it. And then I've seen this time and time again where everyone gets very hyped up and yellows into the market when things in the bullish market are very hot, and they're able to ride it up. But when things start to turn the other way, they're not willing to ride it down. And so, I saw a lot of people in 2022, the um, that their Google went down by 20-30%, their whatever went down, and they sold out, and it took forever for them to get back in. I said, Google's a great price. I was buying at $87, right? That's when I was getting into Google. I didn't really own much Google before then. I had a little bit, but that's when I started to really pile in. So, you have to think about it like it's a business to an extent. And I think sometimes people think about it too quarter to quarter. And you really have to me, maybe it's just because I take things at a 5-10 year approach most of the time. I like to think, okay, where are we at? And I'm cautious that I'm probably going to lose 7 figures on paper when the next dip happens, and I'm okay with that. But would somebody in my position, if I had a family or something like that, would I be okay with that? I'd probably be taking money off the table, right? If I had a family, and I'd probably move a lot of that to the stocks that you're talking about, Steve, the things that pay dividends, the things that are, so anyway, it just really depends upon where you are and what where you want to position. When I speak about what I talk about, Rocket Lab, all that stuff, I'm speaking from what works for me. You always have to listen to what Steve says and what I say and try to relate it to what works for you. So
Yeah, I mean, look, everybody's different. Everybody has different investment styles, and I'm a much different type of investor. I don't go all in on everything. I have different allocations to different things, whether it's growth, whether it's income. And, I'll go back to April when Amit would call me and I would get on his stream in the afternoon driving home from work. And I was one of the only people saying, I don't care what's going on. Like,
oh my
anybody
God, I
knows,
loved it. I was eating it up.
anybody who knows me from that, like, I wasn't trolling anybody. Like, I seriously don't care. And the reason I can say that is because I don't make investments for the short term. I make investments for the long term. I'm not looking to generate 500% over a week's period. And in my retirement account, I'm 100% S&P 500, and I'm allocating every 2 weeks to it. And over a long term, it has allowed me to build a safety net where it allows me to say, I don't care if the market's going down right now, because eventually it's going to be back. And I'm able to buy more of the market at a better price. And if I just so happen to get a dividend on the quarterly dividend during that period, I'm buying more shares. And to me, that really helps invest in individual positions on the other side because it protects me from myself. And, I think, look, I'm all for people. I would love everybody to do 1,000% ROI. I just don't think it's feasible. You know what I mean? I think it's very hard to pick winners early. I give everybody a lot of credit that picked Robinhood. I did not like Robinhood for several reasons, and I was wrong. And I'm happy that a lot of people made a lot of money on it. But, I don't see the opportunities that I saw. Like, I saw the opportunity in SoFi. I saw the opportunity in Palantir. I'm not seeing those types of opportunities right now for things that have tremendous growth like that. I am seeing an opportunity for me in NVIDIA for all the reasons I explained last night. But at the same time, I think that we're going to see a broadening out, so to speak, And I do think income plays are going to come back. Not all of them, though. I still stand by what I said that I don't know why, to me, something like Procter and Gamble's just not exciting. I think that something like Chevron has the ability to increase EPS a lot more than a company like Procter and Gamble, and I'm getting the protection on the bigger dividend. So that's why I would prefer that over Procter. But there's some really interesting plays out there, but everybody has to set their portfolio up for themselves. Don't do what I do, because I do very specific things for very specific reasons. Oh, yield max. We can go down that rabbit hole if you really want to. I actually just wrote an article on NVDY, which I do own.
I'd rather not talk about yield max.
Why? You bad experience?
No, I'm not an advocate.
I mean, it depends how you look at things.
Yes, I'm sure for some people's portfolio it fits extremely well. It does not fit for mine.
No, look, yield max is not something that I am putting a bunch of money into, but at the same time, my idea around it is if I hold one of these things that I think is going to be okay for a year and a half and it pays for itself in the income, and I can strip that income away month by month and then get all my principal back over a year and a half, I then have a free asset generating recurring income for me. So from that aspect, it's interesting.
Mm-hmm.
But it is not something that I think is, a replacement for other things by any means.
Yeah, I think I've just seen it go badly for a lot of these high yielding things too many times.
I'll tell you the ETFs I really like these days, the NEOS investments, the QQQI and SPYI. I'm really gravitating toward those over the JP Morgan ones, JEPI and JEPKIP.
Mm-hmm.
Their call option is very interesting because not only do they sell the call option on the underlying index, but they are taking a portion of that premium and buying out of the money calls. So they're doing a call spread. So if the market goes up, they are then able to participate and their upside's not 100% capped, which is where Global X, I wish they would change their philosophy on XYLD and QYLD, but they're not right now. And I think that's why you're seeing a lot of investors gravitate toward the NEOS investments or even the new ones Goldman Sachs put out. Yeah, that's where we are on yield max. We don't have to go down that crazy road. I'll do a full video.
Yeah, I know you and Amit like it. Maybe you guys can do a separate stream on it. I don't think I would contribute well, and I don't think I've done as much due diligence as you guys have. I've been invested in covered call sort of ETFs in the past, and I've done a lot of research on others. You mentioned a few.
Can I say the one that I know that you're in?
Yeah.
Okay, so I know that you like QYLG.
XYLG.
XYLG. That's right.
Mm-hmm.
Yeah, I happen to think that those are better than just the straight capped cover call ones from Global X. But I wish that they would add the call spread option instead of just being just straight cover calls. Mm-hmm. I really do.
Yeah, I'm trying to, so people are aware, I don't use XYLG in isolation. I'm trying to come up with a proprietary blend of ETFs that I can use that will replicate the S&P 500 return while getting a higher dividend. And so it's with that, it's a 3 to 4, maybe 5 fund sort of blend with ETFs, and each has a set mixture. And depending, my thought process is depending on how much income you want, right? You could potentially increase the blend on something like an XYLG, or if you wanted more income, you could even switch it to XYLD instead of XYLG. I don't want to go into too much detail on the difference between the two. It's rather simple, but it's not the purpose of today's stream. But my hope is with that, and it's been successful so far in this bull market, where you can outpace the S&P while doubling your dividend. And so that's kind of cool. And so to me, my thought process is actually, could I get even slightly more aggressive on my XYLG allocation, and still max? But at the same time, generally these covered call ETFs, they limit your upside exposure to whatever underlying you're in, generally, except for what you're talking about with QQQI, which is why I know you like that. But you're exposed entirely to the downside. And so I think that's part of the reason why I'm a little bit hesitant for people to get involved in these things, because they think, oh, well, I'll just match the S&P 500 returns and get 8% dividend. And it's like, that's not generally how it.
So it's funny. I didn't go into this yesterday, but I actually made something for last night's stream, which is perfect for right now. We're actually talking about it. So let me put on the different view.
Yeah, I'm gonna call it here if you're gonna dive into this.
No. I'm just going off what you just said. It's not going to beat the S&P. Like SPY is right here. Total return for the year is 15.11%. Not a single cover call ETF that I follow beats the S&P. So just putting that out there.
Very good.
Yeah. No, I agree with you. I mean, it's just very different. Very different. But yeah, let's get back to energy. I mean, if you were going to rank the midstream operators, where do you put them? Because they will have their pros and cons.
The midstream?
Yeah.
I don't know much enough about the midstream to be able to rank them, to be honest with you. I really don't.
Really?
Mm-mm.
You're more upstream? All right, so let me ask you this. Have you been looking at Devon or Fang, Diamondback?
Yes, both.
Okay. What do you where are you on those? Because I've done a bunch of research on Devon, and I thought that it was a good time to get into it. I haven't yet. I need to look at that again.
I think any company that is in really good underlying basins that have longevity for 20 plus years, that is a low debt load, that in a downturn, will not go bankrupt. I think it's okay to start to dollar cost average in, and then if there is a large pullback in upstream, that's when you go hard. That's when I did the same thing with Exxon, Shell, undisclosed oil company, back when 2020 happened, and that I held those from 2020, and I dollar cost averaged into those from 2020 until 2021, and then I held them until 2023, and then I liquidated all of them.
Yeah.
No grind life, as much as you would like to think. I've never invested in a yield max fund in my entire life.
Yeah, I mean, look, I'm just not smart enough to know where the acquisitions are going to happen. I do look at the assets and the acreage that these upstream producers have. Devon is certainly, it's always been on my radar.
I like Devon a lot. I think Devon's got a really good asset base.
Yeah, I mean, I need to do more work on that. them and Fang. I started looking at EOG Resources the other day. Somebody told me I should start looking at them, and I was pretty impressed going through their financials. I need to do a little bit more due diligence on them.
EOG is good. EOG is also good. I like EOG. The ones that I'm looking at, once again, it's my thought, and it's not for capital appreciation. It's for long-term dividend appreciation. Is GRNT and NOG.
I don't know either of those.
Exactly.
Say those again. What
Nope.
are they?
Never.
Don't make me rewind the tape. What was it?
No, it's GRNT and NOG.
Granite Ridge Resources.
Yeah. They're to give a synopsis, they're non-operated. They're mostly working interest plays. So it's more around basically being a bank. And so when you think about low overhead, it's able to increase your margins. And so that's more along the line. So they're basically working with high quality operators and choosing which assets to basically get involved in. And so I like the plays that they're in. They're growing really well, and their M&A deals have been extremely good as well. And so I think I forget which one. I think NOG hit like a rough patch, and I think GRNT is rather new. But yeah.
Interesting.
Yeah, I think it's interesting. Like I don't want to get myself in trouble again. I've done some non-operated work in the past. Like obviously some of these upstream companies, when you work on these multi-billion-dollar projects, for example, Guyana, I think Guyana is a really easy one to explain. Exxon is the operator of the project, but you have CNOOC, the Chinese National Oil Company, is an investor. Hess, which now is Chevron, was an investor. They are non-operated partners. So when you go to the offshore platform, you'll see everyone with, Exxon hats, right? When you go to the FPSOs, you'll see everyone with their Exxon badging and everything like that. And so it's Exxon that's really operating, and Exxon owns 45%. I think Chevron will now own 30%, and then CNOOC will own the remainder. But they all, there's technical meetings between everyone that kind of comes up with the future development plans and everything like that. But generally speaking, you have an advantageous position as the operator to kind of drive things a little bit. But at the same time, if you're working with really competent operators, you can just kind of have a very light technical team, if at all. So if like you're working with Exxon, you're like, it's Exxon, right? They know what they're doing, generally speaking. They very rarely make poor financial decisions and poor investment decisions. So like if I was me, would you invest in some of the projects that Exxon invests in? Probably. They're going to make money. So it's like, if you could say, hey, Exxon, you have your team of 100 and you do you operate it with 45% working interest or 50% or 60% working interest. I'm my team of one. I'll operate, or I'll invest in the other 50%. Your margins are going to be much better because they have so much overhead, right? And yes, they'll charge you partly for that operating expenditures, but at the end of the day, they still have to pay, all those people to be able to make some of those decisions. They can't back charge you for everything. So that's the why I like some of those opportunities.
Do you want to get into LNG at all, and why it's advantageous for these companies to ship and export because of spot prices and what they can get on the water and what Japan is paying?
I think it's probably best for another episode. Okay. I don't want to take too long. And also I think you need to hit 3 videos, so it might be advantageous to split this.
Want to just do another one on LNG right now?
Yeah. I mean, I haven't eaten yet today, so
Okay.
I only eat once a day now. So,
Wait, what?
because I'm trying to lose weight.
Yeah, but once a day is not good, man.
Yeah, but I can't eat more than that. Like my medication just doesn't
Okay.
let me. So, um, so yeah, I just have been intermittent fasting pretty much, and so
I tried doing that. I just
it's been working for me. So, um, so yeah, what was I gonna say? But yeah, I mean, I sorry for folks that think I'm trying to avoid the covered call ETFs. I don't want to get into that specifically. I have my own individual covered call ETFs that I invest in. I'm not a fan of yield max. I've seen a lot of people that try to hype it up. And honestly, my thought process is a lot of them will lose money. I've seen a lot of people lose money on some of them. And then they say, oh, but this one, I'm moving to this one, and this was going to guaranteed make me money. And so, yeah, unfortunately, I think a lot of them are poorly run. Um, I saw so many people that I know be like, "Oh, but Ulti changed the way that they're doing things, and now since March, it's going to do really well, and Ulti is not doing well." So, I see so many of these people that have been tried and true and are holding on to it. And what I think a lot of people are still holding on to for yield max, and I'll leave it at this piece, is like, oh my God, but yeah, it's 100% dividend yield. It's like it's 100% dividend yield, but if you think about it, it's also down 70 to 80% from where it was last year. So if you think about it, your dividend yield is continuing to shrink with the share price. And so if you think in that respect, it's like, well, when it also goes down 70 to 80% over the following year, it'll still be 100% dividend yield, but it'll still be 70% less dividend yield than it was the year before. And so my hope is that people recognize that, they look at the long term and longevity of some of these things and don't necessarily rush into them as they see large dividend yields. I've seen just unfortunate behaviors on not from investors, but just from a lot of these companies that offer things north of 20%. It breaks down, and it's very difficult to offer dividend yields north of 20% and maintain that sustainably. It's just difficult to do. So I really hope that people think about it. And if you want to dabble, try to dabble and, you know, do it with a paper account, do it with something that you can afford to lose. And if it works for you, try it out. As I said, um, if it works in your portfolio, like Steve said, it's a part of his portfolio. I hope it works out well for him. I just feel like most people will realize in the long term, as I've come around to, and I've been a part of these covered call ETFs now and have people talking to me about them for the past 5, almost going on 6 years now, since a lot of them have become popular since 2019. Unfortunately, a lot of people that I know investing in 2019 and 2020 no longer invest in them. And I wonder why. And so, that's just my thought. And unfortunately, Yield Max kind of came in at a time where I think in 2023, 2024, where a lot of people were starting to re-enter the market and were not a part of that original covered call ETF wave in 2019 and 2020, and caught a whole new market of people that were unfamiliar with covered call ETFs. And it unfortunately, I think, is going to catch a lot of people by surprise in the long term, especially once we have a pullback. I think everyone is still in this euphoric stage of being in this upswing since the end of 2022 to where we are today. And when we have a 30-40% upswing or downswing, sorry, and it might sustain for 6 months, a year, who knows how long, I think people will start to realize why cover call ETFs might be more dangerous than is originally perceived on the surface. But like I said, there is a place for some of these things in anybody's portfolio, just like there's a place for annuities or corporate bonds or whatever. That's why they're offered. But just recognize that just because it works for somebody doesn't mean it necessarily works for you. Like I said, I have covered call ETFs, but it's a proprietary blend that I'm trying to figure out. on a small subset of capital. It's been working, but I'm using it in combination with other ETFs, not in isolation. And so my hope is that, if you use it, it's successful for you. I don't want anyone to lose money, but just use caution and don't get lured by big flashy numbers.
Yeah, I mean, I'll just add to what Matt said. Look, I do not go into any of the covered call ETFs thinking it's going to outperform the market, because the chances are it's not going to, as I showed with that slide. And you should be very cautious with them. I have them for a very specific reason. And it's because they complement a very large diversified portfolio of over 100 positions to make up my income blend. So I offset it with other things. And when it comes to yield max, I'm in 2 of them, and I'm taking the distributions as cash and sucking the liquidity out of it until I'm free rolling on them. I don't know if it's going to work, but right now it's working out to my advantage. So we'll see. But Matt, if you want to get going, man, I appreciate you being on and talking energy. There's not many people I can sit there and talk energy with for that long. So,
yeah, absolutely. And I'd love to stay more, but I'm getting kind of hangry, as people probably can tell. And let's set up a stream on VG and Next. A lot of people asked me about it. Chris and I have talked about it quite a bit, and maybe we could do a stream with all 3 of us, actually.
All right, I'll send a group text out for that.
And actually, maybe what we could do, I don't know, maybe it'll help, maybe it won't. I don't know. Yeah, we'll discuss it. But yeah, I think since Chris is in it as well, we get asked about VG and Next all the time. So my hope is that people can help. They're the same industry, but in kind of different spots in the business cycle. So it's nice to kind of explain why one or the other. Just to shortfall it before I let you get back to your probably over 500 people, man. 480 people. I like Next.
Matt, I appreciate you being on.
Yeah, no, I appreciate you inviting me. I like Next over VG personally because I think there's more upside to Next. VG is going to be a safer play though. So that's the synopsis. So it really all just depends once again on somebody's risk tolerance and what they want out of a position. Like if let's just say you have $1,000, the only $1,000 you ever had, and you can't add more capital, I would go with Next. But if you need something like if you're going to be adding $1,000 a month and you want guaranteed to be a millionaire, it's one of those positions where it's like VG is almost like a bank, right? It's going to be inevitable. It's going to be guaranteed. It feels like it's already generating a shit ton of EBITDA, but we can get into that to a different time.
All right. I'll send out a group text to you and Chris, and we can go over both of them.
Thanks, man. Congrats on a good second episode, and I'll talk to you soon.
Thank you. Appreciate it, Matt.
Yep.
Later. So I'm going to address the BMNR question. I'm going to stay on for a little bit. So look, I'm not a Bitcoin person. I have said it before. I'll say it again. I don't think that Bitcoin has a lot of utility. I think it's greater fool theory at the moment, and we'll stick with that. I'm not a Bitcoin person. I think Ethereum has a ton of utility. What made me change my stance on crypto was the Genius Act and the legislation around it. And when you go through everything and you look at stablecoin adoption, and when you do the due diligence and you look at where the majority of stablecoins are being built and where the utilization is coming from, MasterCard, PayPal, Shopify all built their stablecoin on Ethereum layer 2. And I am actively buying BMNR. I bought more on Friday. Just because I am buying it does not mean it's good for anybody else. Just because we talked about it at length last night does not mean it's good for anybody else. But for me, I am very bullish on BMNR because I think it's going to trade at a multiple off of Ethereum. And one of the most interesting aspects for me is that if Tom Lee gets to 5%, the network effect from setting up the nodes, being a validator, and the amount that he's going to be able to stake, and then it's not just the staking, it's restaking and restaking through DeFi. So all of that becomes accredited net income immediately. They have very low overhead. And I really do believe that tokenization of real world assets is going to happen. And the amount of stablecoin transactions could be enough to make Ethereum a deflationary asset because they're capped at generating new Ethereum at 1.51%, I believe. So to me, BMNR is just a play on Ethereum that could catch a much larger multiple. So I'm in both. I'm actively buying Ethereum directly and BMNR. So that's my very short pitch. I actually wrote a dedicated article on BMNR back in August. I'll link it in the chat if you're interested in reading it. Let's see. And look, Tom Lee has everybody's ear. Institutionals trust him a lot. I think they're going to be able to raise a lot more capital. It's going to be very interesting. I don't have a price target. I wouldn't be surprised if it's over 100 next year. I wouldn't be surprised if it doesn't move because keep in mind, as it goes up, as Ethereum goes up, he's going to continue to issue shares and he is going to buy more Ethereum. So Tanner does a great job on the MNAV. He does a great job on all that stuff. So he's much more ingrained in the numbers on that. But I'm not a strategy person just because I don't believe in a Bitcoin the way that I believe in Ethereum. That doesn't mean that Bitcoin and strategy aren't going to work out. I'm just not on that side. I'm on the Ethereum side. So I hope that answers what you will want me to answer in regarding BMNR. Let's see. I don't know, Ram. I mean, I'm buying both. I don't know which one's going to do better, so I'm actively buying both. So I couldn't tell you. I'm not going to recommend any. I will tell you that I have covered calls as 67 strike for next week. It's well above my average, so it is what it is. I mean, I can't tell you what I recommend. I'll just tell you that I do have 67s for next week. Let's see. I'm just going to go down and answer questions as they come in. Which ETF, Miro? I mean, something like ETH from Grayscale. I mean, I personally like the treasuries over the ETFs. That's just me. I don't own the ETFs. I'm interested in VG. I need to do more due diligence on it, but I understand a lot about it. I do believe LNG transport is the next frontier. So I need to do some more due diligence on that and next. I think both are very interesting. Yeah, I still have SBET. You know, I had originally said that I was buying BMNR and I have SBET and I have the Ether machine because I don't know who's going to do better at staking and restaking. So BMNR is doing better on capital appreciation. I may move out of them, I may not, and consolidate into BMNR. I'm not sure. So I do think that BMNR has a good upside potential, and that's why I'm very interested in it. It's one of the things I'm most interested in right now. Let's see. Misty. I do own Misty. I mean, I don't know that it's a great ETF. It certainly is interesting with the yield. And as I said before, I'm looking to suck the liquidity right out of it. So if it works, it works. If it doesn't, it doesn't. But right now I'm doing okay on it. So I didn't put a lot of money in it. And no matter what happens, I'm okay with the result. But the idea of being able to free roll an asset when you have something that's that high of a yield, once I get to a net zero basis, whatever the share price is, doesn't matter to me because it'll just be generating recurring income on something that, Matt's trying to make me laugh. I'm going to try not to laugh, but that's a funny comment. I mean, he should probably, I don't know, that's a funny comment. I texted with him that he's okay. He's helping his family out. I don't know what BLSH is. Ahmed, I don't know. It's very hard for me to figure that out because I have a lot of different positions and I don't have everything in one spreadsheet where I could tell you that. So I don't know. I wouldn't be able to tell you. Do I think Noto gets the 45 bonus? Man, I hope so for everybody because that means we're all going to do really well. Look, SoFi is a great company. I'm sure some of you saw the debate that we had a couple months ago. That is SoFi a bank or not? Look, SoFi is a great company. I think it's more of a bank than a technology company at the moment, but we'll see. I need more context on why Derek White left, but I am just Yankee rally. Look, just in case I'm the jinx, I'm not watching it right now. I'm not watching it just in case I'm the jinx. Sometimes I get in these moods where I can't watch the Yankees because I feel like when I watch them, they lose. I go through those spurts, so hopefully they rally because I'm not watching it right now. And by the way, I did watch the Pereira fight this morning. Oh my God. I did not realize that he absolutely did that overhand right that he hit him with. And Pereira's such a weird fighter in the aspect that freaking short front leg kick that he throws is so quick and it's so low that you can't grab it for a single or a double. He just pulls it back so quickly. And the fact that, I mean, it was a great fight. I'm looking forward to number 3. Let's see. Well, I'm not short SoFi. I have a lot of SoFi. I'm not short anything. I don't short stocks. That's just like playing the don't pass at the craps table. I don't do it. I'm long everything I buy. Let's see. Yanks down 9-0. Great. That's not good. If that's true, that's not good after what happened yesterday. I'm not sure what MUR is. RKT, I mean, Matt tried getting me that. I didn't listen. I'm dumb. I should have listened. CRM, look, I think CRM is trading at a very interesting place right now. I've been buying it, not a lot, but I have been buying it. I think there's value to be unlocked. We'll see. I didn't like that Benioff came out and was talking negatively publicly about Palantir. I just don't think that's a good look. But from a business standpoint, I like everything I'm reading on Salesforce. So, and I like the numbers. I think it's undervalued. So I'm in it. We'll see what happens. But Matt, that shows you how much I know. I thought RKT was RKLB. I don't know. How many positions do I have? A lot. I mean, I have a dividend harvesting series that I've ran on Seeking Alpha for the past 239 weeks. And that's a series that I started where I started with $100 and I add $100 per week and built an income producing portfolio on a budget. And that portfolio has 105 positions in it. I mean, some of them aren't really real positions. They're very small. I mean, look, all of them are small positions, but it's interesting to see the results on it. Let's see. AGNC I like. Oklo, I mean, look, I don't know enough about it. I mean, I think it's crazy that it's a pre-revenue company getting the multiple it's on, but hey, is what it is. XLU is interesting. I mean, it's had a run this year. I actually like NextEra Energy and Southern Company a lot, so we'll see. Quantum, I'm not a fan, don't understand it. And I just have this idea that, look, IBM and Alphabet have been working on quantum for so long. If they're not making the breakthroughs, I don't see how these smaller companies will. So I'm not going down that rabbit hole. I'm not putting my energy into researching them. I just don't, I don't see it. I'll get my exposure through IBM or through Alphabet. I can't bring myself to do it. I can't do it. On Wolf, I can. I have my pen right here and I have my pad here. I'll write it down for something to look into. Is that TerraWolf by any chance? Bloom Energy is interesting. I actually asked somebody who knows a lot more about that industry than me a while ago. I need to look at that again. Yeah, I know the Yankees are getting cooked. I mean, I read also. I mean, I missed the boat on those. I got to do more research. CoreWeave, Nebius. I need to look at those again. We'll see. Yeah, I mean, nuclear is interesting. And if you guys watch All In, Freeberg had discussed buying the Global X nuclear ETF last year, I believe, and did well with it. That should have been a sign that we should have looked at it. I mean, I'm looking more at Southern Company again because of their nuclear footprint and Next Era Energy. So that's how I'm getting my nuclear exposure at the moment. I think that there are pockets of the market that are expensive. I can't jump into Aqua right now. Or the other one is NewScale. Mel J, I think it's for the right people. It could be good. I think it depends on which one. So I have a different theory about the cover call ETFs than Matt. I'll do a dedicated video on it, but if you want, I can get. I mean, if everybody's interested in the cover call ETFs, I'll share that slide again, and I'll just go through it real quick. So just give me a sec. So when it comes to the cover call ETFs, I have SPY here, and I did everything from the beginning of the year. And the way that I did is how much capital appreciation there was in the shares, and then the income that that ETF has generated throughout the year, what the yield on cost was, and the total return. The six that I look at are the ones from Neos Investments, from JP Morgan, from Goldman Sachs. None of them on a total return basis has beat the market. Start off with that. These are not things that I look at to beat the market. They are straight for income. I happen to like the Neos Group ones the best right now because of the way that they're structured. They sell cover calls on the index. They take part of that premium and they buy out of the money calls on top of that. And then they will disperse the income. And they've done pretty well. SPYI, 12.15% total return for the year, and QQQI, 14.43%. I like them. I'm in them. But once again, they're part of a very diversified income play. But I happen to like them. So, take it with a grain of salt. And I'm not going to go down options today. We can do a dedicated episode on options, but I will do something on that. Let me write that down. I'm writing down all the ideas that people seem that they want to make videos on. So cover call ETFs. We'll do a full video, and I'll put together a deck for it. Let's see what else. Yeah, I saw that rumor that Tom Lee's going to be on Rogan. I mean, if Tom Lee goes on Rogan, that's going to be insane. And I don't believe the rumor, but we'll see. I've listened to Rogan for the past, I want to say 15 years on his podcast. So I don't remember ever seeing somebody like Tom Lee on there. Now, I haven't listened to every podcast, but I listened to a lot of them. So we'll see. But who knows? Let's see. I don't know what CEG is. So I'd have to look at that. Yeah, I don't know if he's going on Rogan or not. If he does, it'll be crazy. Right? I don't think Rogan cares about that stuff at all. Let's see. Story behind how I got into investing and writing articles. I got investing because of my grandfather, my uncle, and my dad, and growing up caddying for people in finance just kind of stuck with me. And then writing articles, I disagreed with something somebody said, and I wrote an article on Seeking Alpha, and then I just started writing articles again. And then after grad school, I just kind of kept doing it. So, you know, happened. I enjoy it. I'm a nerd. I do a lot of research. So basically my articles or my research are it's a culmination of the research I do, and I put it out there for public viewing, and hopefully it helps people. I mean, I do a ton of research. So you can disagree with me, that's fine. You can agree with me, that's fine. It's really out there for people to do what they want with. But I have an undergrad in economics and I have an MBA. Let's see. TMDX. I'll research it. Lisa, I'm glad. Thank you. Oh, wow. LA Fanatic. I cannot believe you said QXO. Ken is on that so hard for so many reasons. Brad Jacobs, what he did with, what's the company? What's the freight company? I cannot believe I'm blanking on it. I can't believe I'm blanking on it. XPO, I think, maybe? I don't know, but Brad Jacobs has done a lot of good things. So QXO is very interesting. Did I start the stream because you didn't want to watch the Yankees game? Maybe. No, I would have been doing research or something if I didn't start the stream. I'm not watching the Yankees today. I think I'm a jinx right now, so can't do it. DKNG, that sounds familiar. It's not DraftKings, is it? It is DraftKings. Look at that. Yeah, I mean, I just wrote an article about DraftKings. I'll link it in the chat. I knew that sounded familiar. Yeah, look, DraftKings is something I'm really interested in. I think the new tax bill is going to be very bad for DraftKings and other companies that are in the gambling scene. So I want to see how this plays out. The fact that you're only going to be able to deduct 90% of your losses against your wins in 2026 is not good for gamblers. So KPMG, which is one of the big four auditing firms, came out with a whole report on it. I'll link the report. I think you should read this if you're interested in DraftKings because it has very significant ramifications for every company that's in the casino business and sportsbook business. So I'm linking the KPMG stuff. I just linked it here. I'll show it. So you should read this if you're interested. Yeah, prediction markets is going to be very interesting. So best websites are look, I'm going to do a full video on how I do due diligence, but in all seriousness, I either read through or listen to every conference call of the companies I'm interested in. I go through the quarterly report, I go through the press release, and I try to find fireside chats or industry conferences to listen to. So I'm in the car roughly an hour and a half to 2 hours a day. So I make sure that I download as much content as I can so I can listen to it in the car because I don't get that time back. I'm not listening to music in the car. I'm trying not to make phone calls in the car unless phone calls come in from work. I'm trying to listen to as much content as I can. So that cuts down on my research when I'm at home. It helps me maximize my time. Yes, I'm not watching the Yankee game right now. I am a jinx, so I'm not watching it. Phone calls from a minute, yes. Phone calls from a minute, listening to me drive in traffic and honk the horn, yes. No, I'm not. I don't do the subway anymore. Let's see. I'm not. No, it may look. It may be lucrative, but I'm not looking to. I'll never ask anybody to buy anything. I'll never DM anybody trying to sell anything. I'm not looking to put any products out there. I mean, I will just freaking put my DD out there for free. That's what I do. I am doing the research anyway, so happy to put it out. Oh, don't even. No. We're not letting this one go. Sorry, wrong one. Man, you guys are great. We're not letting that go. They're not even in the same category. Don't do that to me. Please don't do that to me. Not even in the same category. People are sleeping on PDI. I agree. I've been saying it for years. I wrote a couple of articles for the street, but I stopped. So technically, yes, it wasn't many. It was maybe 5 or 7, something like that. Look, PDI is interesting. I think fixed incomes to do very good as the Fed cuts rates. So, what is going on here? Heat is great, but a little slow. You guys are hanging out with a mid a lot, aren't you? I mean, geez. I'm going to text him right now, being like, man, a lot of people, I'm going to text him right now. A lot of people in the chat are saying, a lot of people in the chat are saying heat is slow. You may have a better chance of people agreeing with you in this stream. Let's see what he says. I can't believe it. Heat is not slow. Come on. He admits with his family. I'm not going to bother. If he ends up texting or calling me, that's a different story. But I'm not going to bother him right now. Oh, man. Oh, Amit just said a lot of people are smart. Look at that. Oh, man. Look at that. Can't believe it. I got to tell you guys, Heat is just top 5 movie for me. And I started this morning putting together a list. It's going to take a little bit of time. I'm not going to put it out there unless it's like, hold on. Yeah, guys, he's not calling in. He's with his family. He's probably playing cards or something. But I'm going to put out a list. And I think the way that I'm going to do it is I'm going to make different videos with different people about different genres. I'm going to do an 80s. I'm going to do a 90s. I'm going to do an action, do gangster. So here's the thing. I don't consider mob movies and gangster movies the same category. Mob movies are mob movies and gangster movies are gangster movies. Can they overlap? Yes, but they can only overlap into the gangsters section. Gangster movies can't overlap into mob because they're gangster movies. They're not mob movies. So we will get very specific on that. Very specific. Don't do this to me, Heat of Reservoir Dogs. No, I said it's a top 5 movie for me. Don't do that. Just don't do it. But yeah, I'm going to put something out that will be public. I'll do the public link thing on a Google Sheet. That way people can just go straight down the line of movies if they're looking for something to watch. Oh, I appreciate it, Duns. Thank you. Heat is free on YouTube. Look at that. Yes, I love Sopranos, but it's hard for me to go back and watch it fully. I got to fast forward through a lot of scenes. Let's see. What, top 5 movies? I mean, The Goonies is amazing. The Wire is amazing. I mean, I don't know if we're going to say The Wire is better than Sopranos, but Wire is amazing. So, what do you mean tried watching Godfather this weekend? You don't try it. You watch it or you don't. I mean, it's The Godfather. Last Mohican's great movie. Great movie. Letterbox. I'll look at it. Yeah, Sons of Anarchy is great. Did you watch Mayans? I have no idea what I'm going to trim BMNR. I am sure that between Tanner, Chris, myself, and Amit, and anybody else that's in it that's part of the group, I'm sure you guys will know once we start doing something. I mean, I'm still adding, so I'm not even thinking about trimming right now. You guys are going to think this is crazy. I think Fight Club's overrated. I'll say it right now. I think it's overrated. Memento's good. Yeah, Braveheart's amazing. I mean, talk about a top war movie. It's unbelievable. I had somebody try to tell me that the Harry Potter was better than Braveheart. I almost lost it. Almost lost it. Yeah, I've seen Apocalypto, yes. I'm going to watch No Country for Old Men. With the amount of people are talking about it, I can't believe I haven't seen it with the amount of movies I've watched. So I will watch it without a question. Yeah, LOL Harry Potter, yeah. Oh, wow. Yeah. So, all right. For people interested in cards, I got a surprise. I got a treat. Not necessarily a surprise, but I got a treat. Nostalgianomics. So he's on YouTube. He's got a pretty big Pokemon channel. Does rip and ships 5 or 6 times a week. I've been on his Pokemon podcast a couple of times talking about the economics behind it. He will be on the first episode of Alternative Asset Weekly. We're going to do it next Sunday. I think it's going to be next Sunday night. We'll see. I'll update everybody with a time, but we're going to do Alternative Asset Weekly and get into the economics behind it, how we're investing in it. He runs a huge business around it. So it's going to be very interesting. I mean, I personally am stacking sealed product of Pokemon. That's my investment on the TCG side. I'm not watching the Yankees because I'm a jinx. So can't watch it today. Got to take a day off. I'm a jinx. Can't do it. Blow's amazing. Love that movie. Love that movie. How would you place it? I can't answer that because, listen, I don't want somebody necessarily doing what I say I would do in that. Let's say I'm a big proponent of the S&P 500. Let's say Shohei's not coming to the Yankees. He's a great, listen, he could go down as the greatest player of all time. So we can't, Look, I've never watched Pokemon. I don't know anything about Pokemon. I know that it's an investment that goes up. I did the due diligence. Sealed product on booster boxes has outpaced S&P 500. So I am in it. We talked about, chicken burrito, that's a good question. Let me answer something before that. We talked about Energy Transfer, Enbridge, Enterprise Pride Partners, Kinder Morgan, 10KE, a lot of different energy infrastructure plays. It's so hard. Ethan Hunt, Tom Cruise did an amazing job with the Mission Impossible movies. The Bond franchise, it depends what Bond you're talking about, right? Obviously, he's better than Connery because Connery's not the best Bond. Connery is better than Moore. I mean, to me, Daniel Craig is Bond. Always was. I think Pierce Brosnan's amazing, but Craig is Bond. And I don't know. There's something about the James Bond movies that I really like, but I like both franchises a lot. I really do. They're freaking great. It's a good head-to-head matchup. And I would also say people should watch Reacher on Amazon. That's a great show. Great show. Yeah, Bond's a historic franchise, but the older Bonds don't hold up. They just don't. Sorry. They don't hold up. It's not like going back and watching Fast Times at Ridgemont High or Animal House and being able to laugh. Like, go back and watch those Connery Bond movies. They don't hold up to what Daniel Craig's doing. They just don't. Reacher's really good. It's incredible. I mean, gold's been going up. I like gold. Casino Royale is the best Bond film, followed by GoldenEye, my opinion. Casino Royale, then GoldenEye. GoldenEye is probably nostalgic for a lot of people because then N64 game. Let's see. Homeland is so good. Yes. Love Homeland. Hard to go back and watch, but love Homeland. No, you guys are going to think this is crazy. I've never seen a Pokemon show. I've never seen a Pokemon movie, never played the game. I don't know anything about it. I was into sports cards, saw this stuff at shows, started doing research, and my investment mind started working. And I saw that it was a market that was being underutilized at the time. It was a race to the bottom. Sealed product was going for what MSRP was. You could buy it online. After a couple of weeks, the price would go to about $105 a box, sometimes under $100. And I would buy boxes and I would just hold them. And then over the past year, the Pokemon markets exploded. I mean, look, I'm up over 200% on my Pokemon investments inside of 2 years. It's insane. It is absolutely insane. I started buying Pokemon cards August 2023, just over 2 years ago. The first case I bought was Obsidian Flames. And look, I paid, let me go, I'll tell you exactly. I was talking to Ken about this. So when I go to TCG Player and I look up Yankee fans, oh boy, let's see, Obsidian Flames. So cases are going for $2,100 right now, and I bought a case for $650 2 years ago. Well, 2 years and a month ago. I mean, think about that. Like, I don't know that there's a bubble. I don't know that it's going to pop. I don't know if prices are going to come back to reality. I don't know, but oh boy, they're calling me out by nickname, evil investor in the Poke. That's right. Everybody said I was going to get wrecked. I didn't know about it. I wasn't going to do good, blah, blah, blah. Well, it's not. It's like everything else. You do your research, you increase your chances. Yeah, I have a bunch of prismatic. Oh, Dark Wolf was terminal list, not even a question. Dark Wolf is significantly better. Significantly. Fifth Element, great movie. That's on the 90s list without a question. I'm not selling. The Pokemon stuff, I'm not selling. I have no need to sell. Like, unless I need to sell it, that stuff I plan on holding for 20, 30 years and giving it to my nephew. I have no interest in selling. Because once those things go out of print, and here's the investment mindset for this stuff, right? So as it gets out of print and you have the ripping shippers ripping more product. I mean, let's see if Alex is doing a stream tonight. Hold on. I'll show you exactly what I mean. He has a website, Nostalgianomics. All right, so he hasn't put this stuff back up, but I'll show you what he does. So you can buy individual packs from him, and he will rip them live on stream on YouTube and then send you the cards, okay? So this has changed the game for the whole investing community because you have people like him and a lot of other rip and shippers that are bigger, and they're going through a ton of product every week, and they're taking this stuff off the market and it's all being ripped. So every week you have less and less sealed product. And then when it goes out of print, think about this. People are paying 35 from him a pack of Evolving Skies, and they're still ripping them. They're not printing more Evolving Skies. That box, a booster box of that's already at 2,600. I paid 430 for it. I mean, in 5 years from now, think about how much less product there's going to be. It's all supply and demand. So people are going to be wanting to rip it because the Moonbrion, like I know the chase cards because I go on TCG Player and I look. But I'm telling you, my mind is like, okay, if I buy this and I sit there and I hold it, I throw it in a storage unit, eventually it's going to be worth more money because that's what the market has done. So I'm bringing him on next week and I'm going to interview him and I'm going to be asking him a lot of these types of questions. I think people are really going to be interested in what he has to say. And I got to tell you, the business that he's built is incredible. He's done a phenomenal job. I heard about the dentist using the x-ray machine. Crazy. I don't know enough about Big Bear AI. Somebody I know bought a bunch and it's been working out for them. Can you show your portfolio or one of them at 100? No, I'll never show my portfolios or anything like that. I may build a public portfolio that we invest in together, but not showing individual stuff. Oh my God, did I hit 5,000? Beautiful. Thank you, everybody. I actually think I do have a thick Charizard PSA 10. I was buying individual Charizards when the market was bad on them. So yeah, Big Bear AI, I just don't know enough. Look, I like Southern Company, but Dominion and Duke Energy are both good. I like Southern Company. That's the one I'm in right now. The Yankees are heartbreaking. I couldn't watch it today. I mean, not even looking at what the score is. So we'll see. No, I haven't looked into Soundhound. Probably should have with what it's doing. Haven't looked into it. Yeah, look, I like Amazon a lot here. I think I'll do a full deep dive. I'm going to make a note of that for Amazon. Yeah, listen, that's a good point. I mean, I'm going to talk to Sam about that. I reached out to him. I'm planning on having him on and talking about this being one of the topics. I don't know. I think Hood's going to clean up on the prediction markets. I really do. Pulp Fiction or Kill Bill shouldn't even be in the same sentence. Pulp Fiction, obviously. Yeah, Amazon's stuck. I think it's going to get unstuck, though. So we'll see. No. You guys have heard me talk enough about how I eat steak. No, medium rares for me. McDonald's or Burger King? I don't know. It's hard not to say McDonald's. No, I'm not buying Caterpillar, but I love Caterpillar. Oh man, come on, Snatch all day, all day, all day. I wish I knew. Mark, who do you think is the next Palantir Robinhood? Because I have no idea. And that's something when I interview Tanner, I'm going to ask him what he thinks. I have no idea. No, that's how I like my steak, medium rare. Oh, Braveheart. Braveheart over the Patriot, not even a question. Not even a question. Yeah, I'm interviewing Tanner on Wednesday night. Time not solidified yet, but probably like 8, 9 p.m. that area. Eastern. So I'll put something out on Twitter. Let's see. Braveheart over Gladiator. I mean, Braveheart's just it's just amazing in every step of it. No, I'm not a Star Trek person. Star Wars over Star Trek, even though that wasn't the question. I'm like the only one nodding grab, so I don't know. Maybe I'm doing something wrong. We'll see. But I'm just not into. I like U.S. companies. Die Hard is absolutely a Christmas movie. Come on, absolutely. Same with Lethal Weapon 1. Same with Lethal Weapon 1. Oh, come on. The Matrix all day. Strong. I look. All I can tell you is the two things I'm very bullish on right now are Nvidia and BMNR slash Ethereum. I'm not changing my story right now. Like that's what I'm currently acquiring. Yeah, Lethal Weapon 1 isn't a Christmas movie. Absolutely. Beverly Hills Cop, phenomenal. I don't know enough about Shift 4 Toast. I know Brown is very bullish on Toast, so I probably should do more due diligence on that. He seems to get a lot of things right. Oh, listen, if Andrew goes IPO, I'll be so freaking happy. But BST is a closed end fund that I'm in, and Andrew is now one of their top 10 holdings. It's from BlackRock. It's the BlackRock Science and Technology Trust. So, I mean, I like it. It has like an 8% distribution yield. So, do I see it double in what? I mean, if you're talking about BMNR, yes, I think it is going to do very well over the next year. We'll see. I could be wrong, but I think it's going to be good. Yeah, I need to look more at Toast. So, I don't know what type of investor I consider myself because I invest in everything. So, look, I'll tell you, I have 100% of my retirement in the S&P 500. And I think that that allows me to do other things. I have a portion of my money in income producing assets, portion of it in growth, I mean, portion of it in tech. I'm very segmented in how I do things for very specific reasons. I like being very diversified, but that's just me. I mean, Doug, I don't know. I bought more on Friday. Is it a good entry? I don't know. I mean, yes, I keep an emergency fund ready. Like the stuff I put in the market, I don't. I consider it gone, or not gone, but I consider it something I can't tap into. So yes, definitely have an emergency fund on the side. BST. This is a great question. Great question. BSTZ is a term trust where BST is straight closed end fund. So I don't remember the dates offhand. So take what I'm about to say with a grain of salt. But eventually, BSTZ will do an offering and they'll buy back your shares at NAV. So if it appreciates, and let's just say NAV is 40 and it's trading for 35, eventually, I think it's 2032 you'll get the $40 for your shares instead of the 35 that they're currently at. So both have advantages and disadvantages, but I have both of them actually. So no, not going to be a full-time YouTuber. A full-time job, still running for Seeking Alpha. Going to do this on the side also. I do a lot of research and, like sharing it. I'm not in Cardano now. Yes, I like football, but I don't have a team to root for, so I'm spotty when I watch. Let's see. No, I'm not nebulous. I mean, look, I can't be in everything, and I just didn't. I didn't get on the train. We'll see what happens. Oh, here we go. Yeah, exchange traded notes are interesting. I mean, that's what JEPI and JEPQ use. So I got to look at how they're going to be wrapped into crypto. I don't know. I'm not necessarily paying attention to that. What I mean, what would you buy tomorrow if you had 100K and guaranteed to make 10, 15% over the next 6 months? I mean, if you're guaranteed to make it over the next 6 months, it doesn't matter what you buy at that point. I mean, I don't know. Oh, look at Matt. Yeah, look, Matt's been on the Pokemon investing with me. Same with Ken. I mean, he'll tell you his stuff's up. I do own JetCare, yes. Oh, we'll see. I mean, we need AI to push everything, so we'll see. Thank you very much. Appreciate it, Mark. Yeah, these guys are really smart. I'm already a dividend investor, so I'm certainly not 60. All right, here's like, I don't know. I was going back and forth about this the other day. I don't know which one's better. I really don't. I couldn't tell you. They're so good. I don't know how long the shutdown's going to last. I mean, the last one that happened in what, 2018 was? It was like 30 something days. You had one under Obama that was 20 something days. So I don't know. We'll see what information we got this week. Yeah, Lethal Weapon show, I can't do that. I don't know how many watch hours. Um, oh, whoa, 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 whoa. I'm sure you got a pretty penny for that. Yeah, I mean, if you look at Collecticon and how big it's gotten, like if you actually go to these shows, it's wild. It is absolutely wild what is going on. Um, Pulse, I don't know. That's too personal. I don't know. So if you have any information about what their fund is, link it. I want to say. I want to say, but he gave an interview. It was on Instagram, and he was talking about how they're going to build the fund. It's going to include classic cars and all this other stuff. So very interested to see what's going to be in there. But I'm interested, and I will be investing on it without a question. Yeah, Brady cards crazy this year. Absolutely crazy. I mean, it was incredible. I mean, for all you that, I don't know if you remember or not, but when I went to the show over the summer, I said I was trying to get a BGS 9.5 LeBron 2003 Topps Chrome. And normally, and this is where it becomes interesting with shows, because shows used to be where you went to get a deal. They really were where you went to get a deal. And pay cash. Normally, you can get 15% off. I got to tell you, nobody wanted a deal. That card was going for 2,400 at the time. I was trying to buy one for 21, and nobody wanted to come down. And what they said to me is, "There's thousands of people here. We don't sell it. Next person that comes will buy it. If we have to hold it till next week, we'll sell it next week." So I actually think that the strategy now, because a lot of these people, they're just like the backpack watch sellers. They don't have the overhead. Pay a couple $100 for a table to show you're doing really well. So I think that now the strategy is make relationships at your local stores and try to buy individual cards there, because you'll be able to get better prices because they have overhead. They have salaries that they got to pay, electric, rent, everything. So I think you'll be able to do better at stores now. So we'll see. I mean, that LeBron card's gone up a lot. Yeah, Matt, I'm gonna agree with you. A lot of people are gonna be unhappy about that, but Carlito's Way is arguably better than Scarface. I'll agree with you on that to some degree. Um, Private message me the name of it, or if you want to just plug it in the chat. I'm interested to know which store it is. I don't know if these cards are going to be tokenized. I think the higher end assets will be. I don't think you're going to get every card being tokenized. Look, I said it before, I'll say it again. GameStop should buy Collectors. Collectors is the parent company of PSA, and they should convert all their high traffic GameStops into card stores, and they should do in-store grading without having to send it out to a hub and change the game. I gotta tell you, there's a lot of people that would probably rather go to a GameStop than a card shop that's off the beaten path. Alex and I talked about that. We'll talk about it on Sunday. Let's see. eBay, yeah. I mean, eBay's still the 800-pound gorilla in the room. We'll see how long it lasts for. I mean, the fact that Burbank went on to Fanatics platform is very interesting. I have not looked at Galaxy Digital. Nope, I'm not worried about everybody bullish on BMNR. I mean, I'm pretty bullish on it, so we'll see. Yeah, grading is a problem. I mean, you need to get a good grade. Like, I have a magnifying glass I take with me to shows if I'm buying individual raw cards. So grading is very important. I do not know if they're franchises or corporate. I don't know. I don't know what my average on BMNR is. Probably high 40s, low 50s. I actually don't know. Somewhere in that area. Trucker, I'm a normal person. So, yes, you can get a table. We went to Patsy's. I have not looked into 4. I know Tanner's very bullish on it. So, let's see. I don't know what eBay's next move is. They're going to have to do something, though. I mean, look, there's a grading company called Tag. They were supposed to make this grading machine all AI and do encapsulation by robotics and do everything in 10 minutes or so. I think that's the next frontier. I think the only way you're going to crack PSA is by in-store grading machines. No, I'm not. Pokemon is the biggest media asset in the world. I'm not worried about it. Not worried about it at all. And to give everybody an idea, if you go to gemrate.com, how big the grading market is, it's crazy. I mean, PSA graded 75,000 cards yesterday alone. In the past 60 days, the past 30 days, 1.6 million cards they've graded. That's just PSA. It is wild what is going on here. Absolutely wild. The sports card hobby is just incredible. And I'm telling you, more people are looking at these as alternative assets. There's more and more content about it. More people are treating it like this. It's really something else. And I think that there's a lot of alpha there. And I think O'Leary brought a lot of people to the table with us. I really do. Let's see. Yeah, it's a huge deal. Huge deal. I do not know about the AI pack see-through. Mariners could win tonight. We'll see. We'll see. I don't know. We'll see if Mick calls me or not. If he calls me, I'll hop on, but we'll see. I appreciate everybody. So I took a lot of notes. I am going to do a dedicated show on Yield Max. I'll do a VG and next one with Chris and Matt. I'll get them on, and we'll do them. I'm going to look into TerraWolf. I'm going to look into Iran. I'm going to do an options show. I'm going to do a cover call ETF one. We'll do an LNG one with Chris and Matt. I'm going to look into TMDX. I'm going to look into Toast. I'm going to look into QXO. I'm looking at Letterbox. I'm going to bring some additional people on. So it'll be interesting. I appreciate everybody showing up impromptu. Hopefully you find the content valuable and appreciate it. I mean, I appreciate everybody showing up. So I'm going to go get some dinner, try to write another article tonight. So I'm going to interview Tanner Wednesday night. I'll put something out on X about it, and we'll go from there. May come out with an impromptu maybe tomorrow or Tuesday before. We'll see at night. But yeah, appreciate everybody showing up. Really appreciate it. And what's everybody getting for dinner? I'm going to go get some pasta. Options. All right. We'll do an options one. We'll do an options one. Fried rice sounds good. Oh, should I do Chinese? May have to do Chinese. We may have to go get some Chinese or have Chinese come to me. Yeah, fried rice sounds good. No, I'm ordering out Sunday night. I'm not cooking. No way. Yeah, it sounds really good. All right. Well, thank you, everybody. I'm going to end the stream here and see everybody later. Thank you very much. Have a great night, everybody.